Accounting standard number 12, that is accounting for government grants, introduced from 1st April 1994. So, government grants are assistance by government in cash or kind to an enterprise for past or future compliances with certain conditions. Such grants are sometimes called by other names such as subsidies, cash incentives, duty drawback, etc. There are two approaches to the treatment of government grants. The first one is capital approach, under which a grant is treated as part of the shareholders' funds, and the second is the income approach, under which a grant is taken to income over one or more periods. Government grants related to specific fixed asset should be presented in the balance sheet by showing the grant as deduction from the gross value of the assets. Where the grant covers the total cost of the assets should be shown in the balance sheet at a nominal value. Alternatively, the grant may be treated as deferred income and allocated in the profit and loss account over the useful life of the assets. Grants related to non-depreciable asset should be credited to capital reserve. Government grants related to revenue should be recognized on a systematic basis in the profit and loss account over the periods necessary to match them with related cost which they are intended to compensate. Government grants of the nature of promoters' contribution should be credited to capital reserve and treated as a part of shareholders' funds. The standard recommends the following disclosures in the financial statements. Number 1, the accounting policy adopted for government grants, including the methods of presentation of financial statements, and number 2, the nature and the extent of government grants recognized in the financial statements, including grants of non-monetary assets given at a concessional rate or free of cost. So, this is the accounting standard number 12, that is accounting for government grant. Then next accounting standard is accounting standard number 15, employee benefits, introduced from 1st April 2006. So, this standard prescribes accounting and disclosure for all employee benefits except employee share-based payments. So, the standard specifies the following 4 categories of employee benefits. Number 1, short-term employee benefits such as wages, salaries, and social security contributions. For example, contribution to insurance company by an employer to pay for medical care of its employees, paid annual leave, profit sharing, and bonuses if payable within 12 months of the end of the period, and non-monetary benefits such as medical care, housing, cars, and free or subsidized goods or services for current employees. The standard requires that an enterprise should recognize and debited amount of short-term employee benefits when an employee has rendered service in exchange for those benefits. Second, post-employment benefits such as gratuity, pension, other retirement benefits, post-employment life insurance, and post-employment medical care. These are classified as defined contribution plans or defined benefit plans depending on the economic substance of the plan. Under defined contribution plans, the enterprise obligation is limited to amount that it agrees to contribute to the fund and in consequence actuarial risk that benefits will be less than expected, and investment risk that assets invested will be insufficient to meet expected benefits fall on the employee. All other post-employment benefit plans are defined benefit plans. Accounting for defined benefit plans is complex because actuarial assumptions are required to measure the obligation and the expense, and there is a possibility of actuarial gains and losses. Moreover, the obligations are measured on discount basis since they may be settled in many years after the employees render the related services. Defined benefit plans may be unfunded or they may be wholly or partly funded by the contributions by an enterprise. Number 3, other long-term employee benefits including long service leave or sabbatical leave, jubilee or other long service benefits, long-term disability benefits, and if they are not payable wholly within 12 months after the end of period, profit sharing, bonuses, and deferred compensation. The standard requires a simplified method of accounting for other long-term employee benefits than for post-employment benefits by requiring that past service cost should be recognized immediately. Then, termination benefits. Termination benefits are employee benefits payable as a result of either an enterprise's decision to terminate an employee's employment before the normal retirement date or an employee's decision to accept voluntary redundancy in exchange for those benefits, that is voluntary retirement. Accounting standard number 17, segment reporting, introduced from 1st April 2001. The objective of this standard is to establish principles for reporting financial information about the different types of products and services an enterprise produces and the different geographical areas in which it operates. The standard is applied in presenting general purpose financial statements. The dominant source and nature of risks and returns of enterprise should govern whether its primary segment reporting format will be business segments or geographical segments. If the risk and return of an enterprise are affected predominantly by differences in the products and services it produces, its primary format for reporting segment information should be business segments with secondary information reported geographically. Similarly, if the risks and returns of the enterprise are affected predominantly by the fact that it operates in different countries or other geographical areas, its primary format for reporting segment information should be geographical segments with secondary information reported for groups or related products and services. Internal organization and management structure of an enterprise and its system of internal financial reporting to the board of directors and the chief executive officer should normally be the basis for identifying the predominant source and nature of risks and differing rates of return facing the enterprise. Business and geographical segments of an enterprise for external reporting purposes should be those organizational units for which information is reported to the board of directors and to the chief executive officer for the purpose of evaluating the unit's performance and for making decisions about future allocation of resources. A business segment or geographical segment should be identified as reportable segment if a. its revenue from sales to external customers and from transactions with other segment is 10% or more of the total revenue, external and internal of all segments, or B. its segment result, whether profit or loss, is 10% or more of number 1. the combined result of all segments in profits, or number 2. the combined result of all segments in loss which is greater in absolute amount, or C. its segment assets are 10% or more of the total assets of all segments. A segment identified as a reportable segment in the immediately preceding period because it satisfied the relevant 10% threshold should continue to be a reportable segment for the current period, notwithstanding that its revenue result and asset all no longer meet the 10% threshold. If segment is identified as a reportable segment in the current period because it satisfies the relevant 10% thresholds preceding period segment data that is presented for comparative purposes should, unless it is impracticable to do so, be restated to reflect the newly reportable segment as a separate segment even if that segment did not satisfy the 10% threshold in the preceding period. Segment information should be prepared in conformity with the accounting policies adopted for preparing and presenting the financial statements of the enterprise as a whole. Assets and liabilities that relate jointly to two or more segments, if and only if their related revenues and expenses also are allocated to those segments. Then accounting standard number 18, related party disclosures. It is introduced from 1st April 2001. This standard is applied in reporting related party relationships and transactions between a reporting enterprise and its related parties. Related party disclosure requirements do not apply in circumstances where providing such disclosure would conflict with the reporting enterprise duties of confidentiality as specifically required in terms of statute or by any regulator. It is stated that no disclosure is required in consolidated financial statements in respect of intra-group transactions. Also, no disclosure is required in the financial statement of state-controlled enterprises as regards related party relationship with other state-controlled enterprise and transaction with such enterprises. If there have been transactions between related parties during the existence of related party relationship, the reporting enterprise should disclose: number 1, the name of the transacting relating party; number 2, a description of relationship between the parties; number 3, description of the nature of the transactions; number 4, volume of transactions either as an amount or as an appropriate proportion; number 5, any other elements of the related party transactions necessary for an understanding of financial statements; number 6, the amounts or appropriate propositions of outstanding items pertaining to related parties at the balance sheet date and provision for the doubtful debts due from such parties at that date; and number 7, the amounts written up or written back in the period in respect of debts due from or to related parties. Items of similar nature may be disclosed in aggregate by type of related party.